Stocks pulling back this week, heading for the worst week that we have seen in quite some time. Lots of worry just about what the Fed is going to do next, how high rates are going to climb in order for the Fed to get a better handle on inflation. So let's talk about what all this means for the markets, what it signals for the markets going forward. We have our all-star panel here for you guys to help break this all down. We have John Gagliardi, Fidelity Investments Vice President, Christina Hooper, Invesco Chief Global Market Strategist, and Thomas Hayes, Great Hill Capital Chairman. Great to have all three of you here. John, let me start with you just in terms of what we heard from Powell this week, once again messaging the fact that maybe 2 more rates are going to be needed. The market, though, ignoring that. What do you make just of the fact that that keeps happening time and time again, and what it signals?
So the Fed is a player in the market, and they're the biggest player, so they cannot be ignored. And it's normal, right? All of this is normal because the Fed is always in the markets. They've been around for 100 years. So all of this we got to take with, this is just the way it is. But the fact that markets are kind of chugging forward here, and I've been saying this for a couple of years, above 4,200, it really starts to get hard for the bears to make an argument that we're going down as we're going up. 3 higher highs, how many more higher highs and higher lows does it take for the bears to say, maybe the bulls have got it?
But is another rate hike, though, going to change that?
Well, I'm going to argue that there isn't going to be another rate hike. That what we're seeing, that dot plot is a paper tiger. Jay Powell is a paper tiger right now. He wants to keep a lid on financial conditions from easing. And so the way he's doing that is by releasing that dot plot and going on and continuing to say, we're going to hike rates more. But the reality is that the Fed doesn't want to hike rates more, that we're in a similar situation to where we were in May 2006, where Janet Yellen was telling them, don't hike anymore. We did it right in 94, 95. Don't keep going. But there is that interest in keeping that lid on financial conditions, not letting markets get ahead of themselves. That's what Jay Powell's doing. And in fact, he's achieved his goal this week because we have seen that pullback in markets.
Thomas, are you nodding your head there?
I agree with Christina 100%. They have to pin long-term inflation expectations to manage behavior. So they don't want people to expect prices to go up. They want people to expect inflation to come down. But I don't think they're going to raise because you have owner's equivalent rent now kicking in off of very high base effects. So that lags the deceleration in the increase in home prices by about 18 months. And we're going to get a big drop in July well before the live meeting. So I think the skip turns into another skip, turns into a pause. And if you look at 5-year inflation break-evens, they've been very successful with this targeting in a sense that 5-year break-evens are at 2.18%, back to levels we haven't seen since 2018. So they're being very successful with the hawkish talk and the dovish actions.
So it almost sounds like you guys are saying that the market's reaction, even to Powell's messaging this week, the fact that he is saying he's more hawkish rhetoric, yet looking past that seems to be what you guys think is the right response.
Absolutely. Well, that's going to help prevent another rate hike, right? That would really be the catalyst. I think of a few different triggers that could be the catalyst for another rate hike. One, of course, is the market getting ahead of itself. The other is if we did see a Michigan inflation expectations print that's higher than expected. Recall that that was one of the 2 triggers for the Fed to go from 50 basis points, as it had telegraphed, to 75 basis points in June of 2022. But beyond that, I think that we're moving in the right direction, and that finally markets are listening to Powell, even though I don't believe him.
What do you think it's going to tell us just in terms of the leadership here? Because so much of the conversation about the gains since the start of the year has been obviously concentrated by just over a handful of names within the tech sector. We have seen that market breadth broaden out just a bit. Not enough, I don't think, to get too excited about. But obviously, it's a step in the right direction, right?
You know, for me, I hate to sound like a broken record. By the way, Christina and Tom are awesome. I'm the only person here. I have no idea what Jay Powell and the Fed's going to do. And I don't
think any of us do. We all just like talking about it. We all like guessing. You know, it makes for good conversation.
What are you talking about? I brought in my crystal ball. Come on.
Every time they do something, it's always shocking. And the market's reaction is always kind of surprising as well. But this feels like more normal. The fact that we see the top 10 names in the S&P outperforming the S&P, it's LeBron James, it's Michael Jordan. They score the most points in the game. What would be really unusual if a person comes from the bench and outscores LeBron James? That would be weird. But in this case, we really have the leaders leading. And I know earlier this morning we had somebody talking about home builders as an analyst, and home builders are leading. They're at all-time highs. So there are some of your secondary and tertiary players who are starting to lead. So as you said, it is broadening out, and sector rotation is the lifeblood of a bull market.
Tom, do you think we'll continue to see some of that rotation into names out of technology?
I think that's the trade for the second half of this year. So you've seen, up until about a month ago, the bottom 93% of the S&P 500 in aggregate had performed about 0% year to date. Moving forward, we see a scenario for the second half of the year. Maybe you have mid to high single digits more for the indices. I don't think the money is going to be made in the indices. I think the money is going to be made, the magic is going to happen underneath the surface, and those 90% are really going to benefit. And I think with the Fed getting out of the way, the dollar resuming that downtrend that it started in October could be monstrous for multinationals, specifically the ones that get more than 50% of their revenues from abroad. Emerging markets trade could start to get bids. Some of the higher risk groups like biotech could start to get some inflows. So there's a lot to do under the surface moving into year end.
Christina, do you agree with that, just in terms of the leadership that we could see?
I do think so. I mean, what we're seeing right now is pretty normal for this component of the market cycle, right? Markets are anticipating an economic downturn, and we tend to see a narrowing in leadership. But then once the pause really does feel like a pause to markets, that's when they're likely to start discounting that economic recovery, and that's when I think we'll see that rotation to smaller caps, to cyclicals, and that would signal a very different kind of market environment because of that expectation. So that is usually when we see much broader leadership and more participating.
John, how much of the excitement in the markets this year, and particularly what I'm talking about, is this hype around AI? There's been so much talk of the FOMO trade, people seeing how much so many of these stocks, some of these stocks, I should say, have risen, and they want to jump on board. Is the FOMO trade, is that still a thing? Or as we start to see broader participation, maybe that's going to be a conversation of the past?
It's the new story. So there's always three things that drives a stock forward, and Peter Lynch talked about this all the time. There's the story, there's the numbers, and then there's the chart. So when I look at this, I always think of, well, what's the current story? And the market needs, the story is like the lifeblood, right? Because if we stand around and look at balance sheets and charts all day, it's kind of a snooze fest because it's yesterday's newspaper. What's the future hold? And when you say AI, it is exciting, and you are going to need chips, and you are going to need tech. And we're seeing that same leadership that we saw coming out of COVID taking over again. It's so surprising. This year has been so confusing for investors. Remember the beginning of the year? We were all talking about industrials and healthcare. Mm-hmm. We were a stone's throw from all-time highs, and they took a back seat all of a sudden. Tech came roaring back with semis yet again, and it felt just like, here we go. It feels like 2021 regurgitated. And to be fair, like you said, it's the beginning of a new bull market cycle. It's usually financials, consumer discretion, and tech.
What about all the talk, though, outside of the U.S.? The more and more people that we've been having on recently talking about just the outperformance of the U.S. up until this point this year. And maybe it's time to start adding some exposure to internationals. Is that an opportunity, Tom, that you think makes sense, given the fact that I know you guys are very encouraged and very positive, maybe that the Fed isn't going to raise rates again, but what if they do?
Yeah, I think it's not an either or, it's a both and. Mm-hmm. So I think tech can continue to perform, but maybe on a relative basis underperform for some of these groups that are going to do well. So we have two kind of themes. Number one is the dollar-based theme. The dollar weakening is going to be very positive for emerging market inflows and international stock inflows. And they're just starting to break out. Global stocks ex-US relative to bonds, which has been in a sideways channel for 10, 11, 12 years. Now they're starting to take off. So I think that's going to be a monster outperform trade, not at the expense. It doesn't mean NVIDIA has to crash or Apple has to crash or Microsoft. It could just mean that those consolidate, they perform less well, and then you start to see more and more flows into emerging markets. And I think you've got the dollar trade, but you also have the interest rate trade, which is going to be reflected, as Christina said, in banks as their loan books get better, as their balance sheets get better, as their funding costs get quantified. And a group that no one loves, which is REIT, which is interest rate sensitive, could start to get a bid as well. But we love the emerging markets. We love the China trade moving forward, which is a little hairy right now, but I think you're going to see some positive things in the second half.
Christina, should investors be using a week like this week, where we did see some downward action in the market, should they be using dips like this to buy?
Absolutely. But just to key off the international conversation, they can't think just domestically. there are opportunities outside the U.S., and especially given that the dollar is likely to weaken as we go into the back half of this year, this is a time to be shopping selectively internationally. So some developed international, but also in particular, I'm excited about Asia EM. And part of it is that China reopening story, but you can play that with Chinese stocks or with some Asia EMs that are likely to benefit. We have to think about the China story as one in which they were closed for a lot longer than other major economies. That is a very coiled spring. And so this reopening has legs, and it's actually going to be helped along by what I think is going to be some significant stimulus from China, both monetary, we started to see that reduction in policy rates, but also some fiscal stimulus.
All right, guys, as we wrap this up, we're going to go around the horn real quick, and I'll give you two options. Either your top trade for the second half of the year or the #1 data point that you will be watching that you think is so critical outside of inflation. We all know inflation is maybe the easy answer there. But what else are you watching? John, you first.
I focus so heavily on the S&P because that is the benchmark. That's what everyone is based on, and that's responsible for most of your returns. Market does well, we all do well. So I'm watching very closely to see how the S&P reacts, and as excited as we are now, like everybody planted their flag and said 20%, we are now in a new bull market. I think everyone's saying that just in time for the summer slowdown. So I'd like to see around August, what does the market look like then? And if we pull back, there may be some opportunities in the future.
Christina?
Two, Asia EM, and I'm very excited right now about investment grade corporate bonds. We have to recognize this is a golden age of fixed income. We haven't talked about that, or we're pretty close to a golden age, after having gone through the pain of last year. Now that rates have risen significantly, there's an abundance of opportunities within fixed income. The one measure, the one metric I'm going to be most focused on, I mentioned this, Michigan consumer inflation expectations. I think it's critical. It's not technically inflation, but I think it's an important part of the Fed calculus.
Tom?
I think the biggest trade for relative outperformance for the second half is going to be emerging markets in China. I think the stimulus is going to be bigger than people expect, and I think it's not going to be a linear recovery when it actually kicks in and we see second quarter earnings. We just had the 618 holiday. We saw the retail sales up 14.8% for Alibaba. People are going to be surprised by that, and there's going to be a chase. Opinion follows trend. When price goes up, all the money is going to start to follow in. That's one. And I think the second laggard that I think is going to be a relative outperformance is going to be small caps. And regional banks is a major part of that story. And I think you're going to start to see those get bid in the second half. And we're pretty excited about that.
All right, guys, we got to leave it there. This is a great all-star panel to wrap up what has been a pretty eventful week here for the markets. Tom Hayes, Christina Hooper, and John Gagliardi. Thanks so much for joining us here. That does it for us today on Yahoo Finance, but make sure you stick around 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.